Shanghai just broke silver's pricing model. COMEX can't explain it. Something just broke. Not a stock, not a bank, not a currency. The pricing model that has controlled silver for over 50 years, the mechanism that every fund manager, every trader, every central bank has relied on, just cracked. And it didn't crack in New York, it didn't crack in London, it cracked in Shanghai. Stay with me, because what just happened in China's commodity markets is one of the most significant and most ignored financial events of 2026. And by the time most investors figure out what it means, it will already be too late to position ahead of it. Here's what we're going to cover today. We're going to look at why Shanghai is now openly challenging COMEX's authority over silver pricing. We're going to look at what happens when the world's largest physical buyer of silver decides it no longer trusts the paper price set in New York. And we're going to look at what history tells us happens next when a pricing system breaks down under the weight of its own contradictions. Most investors have no idea this is happening. They're watching silver's spot price tick up and down on their brokerage app and thinking it's just another volatile commodity. They don't realize they're looking at a number that is increasingly fictional. That's not sensationalism, that's math, and we're going to walk through it together. By the end of this video, you will understand something that the majority of retail investors, and frankly, a lot of professional ones, have completely missed. You'll understand why the silver market is entering a structural repricing phase, why Shanghai is the trigger, and what the smart money is quietly doing right now while everyone else argues about Fed rate cuts. Let's start from the beginning. Act 1. The architecture of control. To understand what just broke, you first need to understand what was built. For decades, going back to the post-Bretton Woods era, the global price of silver has been set primarily through two exchanges, the COMEX in New York and the LBMA in London. These are the dominant pricing venues. When you look up silver price on any financial website, the number you see is derived from activity on these exchanges. Here's the critical thing to understand about how COMEX works. COMEX is predominantly a paper market. For every ounce of silver that changes hands physically, hundreds of ounces, sometimes thousands, are traded as paper contracts, futures, options, derivatives, claims on silver that may never be delivered, held by traders who have no intention of ever touching a physical bar. This isn't a secret, it's the design. The theory is that this paper market provides liquidity, allows producers to hedge, and gives price discovery a global benchmark. And for a long time it worked reasonably well, or at least nobody with enough power had a reason to challenge it. But here's where it gets interesting. The ratio of paper silver to physical silver on COMEX has been climbing. At certain points in 2025 and into 2026, the ratio of open interest to registered deliverable silver has reached levels that would have seemed absurd 20 years ago. We're talking about a market where the claims on silver dwarf the silver that actually exists in the vaults. Now ask yourself a simple question. What happens to a pricing system built on paper when the physical world stops agreeing with the paper price? Act 2. Enter Shanghai. China has been building toward this moment for years. The Shanghai Futures Exchange, SHFE, and the broader infrastructure of Chinese commodity trading has quietly grown into one of the most powerful physical demand centers on the planet. China is the world's largest consumer of silver, not just for jewelry, not just for coins, for solar panels, for electric vehicles, for semiconductors, for the AI data centers being built at a pace the West can barely comprehend. China doesn't just want silver, China needs silver, industrially, structurally, at a scale that makes Western demand look almost trivial by comparison. And here's what changed in 2026. Chinese buyers, both state-affiliated entities and large industrial consumers, began showing a consistent willingness to pay premiums above the COMEX spot price to secure physical silver. Not just a small premium, premiums that, at their peak, reached levels that made traders in London and New York stop and stare at their screens. Think about what that means for a moment. If I offer you a paper contract for 100 ounces of silver at the, quote, official price, and simultaneously a buyer in Shanghai is paying $10, $15, $20 more per ounce for physical metal right now, delivered to a vault in China, which price is real? The paper price in New York that nobody is actually trading physical silver at, or the cash price in Shanghai where metal is physically changing hands? This is the fracture. This is what broke the model. When the physical market and the paper market diverge in a sustained and structural way, the paper market doesn't correct the physical market. Eventually, and history is extremely clear on this, the physical market corrects the paper market. The price has to come to where the real metal is. The question is when, and how violently. Retention beat 2. Now here's where most analysis stops. They tell you, Shanghai premiums are rising, and leave you there. But we need to go deeper, because the Shanghai premium story is actually the surface layer of something much bigger, something that involves de-dollarization, the structural silver supply deficit, and a shift in geopolitical power that has direct consequences for your savings. Stick with me. Act 3. The supply deficit nobody is talking about. Let's talk about silver supply. The Silver Institute, the most authoritative source on global silver supply and demand, has documented something extraordinary over the past several years. The world has been consuming more silver than it produces, year after year. The deficit isn't trivial. We are talking about hundreds of millions of ounces of cumulative, above-ground stock drawdowns. Silver that was sitting in vaults, in ETFs, in COMEX warehouses, being steadily consumed by the industrial economy. And unlike gold, where nearly every ounce ever mined still exists somewhere above ground, silver gets used up. It gets destroyed in the manufacturing process. It goes into circuit boards and gets discarded. It goes into solar panels that get installed and forgotten. The recycling rate for industrial silver is shockingly low compared to what you'd expect from a precious metal. So we have a market where physical demand is outpacing supply, where industrial consumption is structurally growing, driven by the green energy transition, and where the paper pricing system was set up in an era when none of this industrial demand existed at current scale. The math doesn't work, and China knows it. When Chinese industrial buyers look at the silver market, they're not looking at it the way a retail investor in America looks at it, as a safe haven, as a hedge against inflation, as portfolio insurance. They're looking at it as a critical input for manufacturing, a supply chain vulnerability. And supply chain vulnerabilities get handled one way in China, by securing supply ahead of time at any price necessary, before the shortage becomes critical. That's not speculation, that's procurement strategy, and it's happening right now. Act 4. De-dollarization and the pricing war. There's a layer underneath all of this that we need to address directly, because it's the piece that makes the Shanghai story much bigger than just a commodity trade. The COMEX silver price is denominated in US dollars. When COMEX sets the price, it sets it in dollars. When paper silver contracts trade, they trade in dollars. The entire pricing architecture for silver is, at its foundation, a dollar-denominated system. Now consider what has been happening geopolitically since 2022. Russia's foreign exchange reserves, held in dollars, were frozen. The weaponization of the dollar payment system through sanctions accelerated a conversation that had been happening quietly for years in Beijing, in Riyadh, in New Delhi, in Brasilia. What happens if you hold your wealth in dollar-denominated assets and the rules change? The answer China and several other major economies have been acting on is you diversify away from dollar-denominated systems wherever possible. Gold purchases by central banks have hit record levels. The BRI framework increasingly facilitates trade in non-dollar currencies, and commodity pricing, including silver, is increasingly being considered through the lens of why should the price of a physical metal that we mine, process, and consume be set by a paper exchange in a country we're in strategic competition with? This is not a fringe view. This is the stated direction of policy in multiple major economies. And when the world's largest silver consumer begins pricing physical silver at a premium to the COMEX dollar price, and when that premium becomes a permanent structural feature rather than an occasional anomaly, what you're witnessing is the early stages of a parallel pricing system emerging. Not a revolution, not overnight, but a fracture, a crack in the foundation. If these conditions continue, if Chinese industrial demand stays strong, if the supply deficit persists, if geopolitical bifurcation deepens, the math begins pointing toward a scenario where the COMEX paper price becomes increasingly irrelevant to where physical silver actually trades. Historically, when paper prices and physical prices diverge at scale, the resolution is violent and fast. The paper price doesn't win, it never does. Act 5. What smart money is doing. So what do you actually do with this information? Let's be clear about what we're not saying. We're not saying silver is going to a specific price by a specific date. Anyone who tells you that with certainty is selling you something. Markets are complex, timing is genuinely difficult, and macroeconomic theses, even correct ones, can take far longer to play out than anyone expects. What we are saying is this: the structural conditions for a significant silver repricing are more clearly in place in 2026 than they have been at any point in recent memory. The supply deficit is real and documented. The Shanghai premium is real and observable. The de-dollarization trend is real and accelerating. The industrial demand story, solar, EVs, AI, infrastructure, is structural, not cyclical. Smart money doesn't wait for the repricing to be obvious. By the time it's obvious, the opportunity is past. What we're seeing in the institutional space is quiet but telling. Certain family offices, certain commodity-focused hedge funds, certain sovereign wealth funds in Asia, they are not waiting for CNBC to tell them the silver trade is on. They are already positioned. They are already taking physical delivery. They are already watching Shanghai premiums the way a doctor watches a patient's vitals. The retail investor who figures this out 6 months from now will buy at a much higher price. The one who figures it out today has a different set of options. Physical silver. Silver ETFs backed by allocated metal. Mining equities with leveraged exposure to the silver price. Each of these carries different risk profiles, different liquidity characteristics, different tax implications depending on where you are in the world. Do your own research. Consult a financial advisor. Understand what you own and why you own it. But understand this: the window between early and obvious is closing. Let me leave you with a question. We've spent the last century building a global financial system where the price of a physical commodity, something you can hold in your hand, something with real industrial utility, something that gets consumed and destroyed by the economy, is set by a paper exchange, denominated in a single country's currency, controlled by a handful of institutional players. And for a long time, that system held, because nobody with enough power had both the incentive and the ability to challenge it. That's changing. Shanghai isn't just setting a different price for silver. Shanghai is asking a much deeper question. In a world that is fracturing along geopolitical lines, in a world where physical supply chains matter more than financial derivatives, in a world where the country that controls the pricing mechanism controls the economics, why should the West control the price of a metal the East consumes? That question doesn't have a simple answer, but the market is beginning to answer it anyway. If the COMEX paper model holds, we'll look back at this moment as an interesting but ultimately irrelevant divergence. But if it doesn't hold, if the fracture widens, if the physical market continues to demand premiums that the paper market can't explain, then we are at the beginning of one of the most significant commodity repricing events in a generation. The silver market has been distorted by paper for a long time. Shanghai may have just started the clock on how long that can last. Stay informed, stay positioned, and ask yourself the question that most investors aren't asking yet. What is silver actually worth when the paper price no longer controls the answer? This video is for educational and informational purposes only and does not constitute financial advice. Investing in commodities, mining equities, or precious metals involves significant risk, including the potential loss of principal. Past performance is not indicative of future results. Always conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions. If this changed how you think about the silver market, subscribe. The next video goes even deeper into COMEX mechanics and what the options expiration data is quietly signaling right now. You won't want to miss it.